Hi, I'm Joshua, and you're watching Taped with Rabbi Doug.
We're gonna see Rabbi Doug. We're gonna see Rabbi Doug. We're gonna see Rabbi Doug on your TV tonight.
But Daddy, I want to watch Monday Night Football.
Forget about Monday Night Football. There's no other thing we're going to watch on Monday but Rabbi Doug.
Yeah, Rabbi Doug on TV tonight. We're gonna see Rabbi Doug. Oh, everybody talk about Doug.
Shalom and welcome to Taped with Rabbi Doug. We are here in the offices of Howard Suss. Howard, welcome to the show.
Thank you.
A pleasure to be with you. Today's subject is financial planning, and that's what Howard does. I just want to tell you a little bit about him. He has been the president of Suss Financial Group in Skokie for 7 years and previously worked for Financial Group Limited in Rosemont. So he has about 9 years you were there, so you've been in the business for a long time. He received his MBA from Loyola.
Even though I look so young, I know that. But yes, I've been in for a long time.
He received his MBA from Loyola and has his RIA Registered Advisor certification. He specializes in working with seniors in retirement planning, estate planning, so you know a lot about that. He also works with life and disability insurance. He also concentrates on special needs planning for individuals with disabilities and their families. And you have a lot of experience in this area because one of your children has Down syndrome.
Yes.
He's currently the chairman of the board of Chicago Yachad, serves on the board of directors of Congregation Adas Yeshurun Synagogue in West Rogers Park. He was previously president of that congregation. He also is on the board of directors for the Hebrew Theological College and Ari Crown Hebrew Day School. And he lives in Chicago with his wife Zahava, and there are 6 children, and I know them well, and it's just a pleasure to have you here on the show. And we've talked about this for a long time. I haven't had a financial planner on the show in many years, and I think that in today's economy, with what's going on, I think people are really confused on where to go with their money or with the money they don't have. And I think there isn't sometimes a lot of difference nowadays. A lot of people are out of work. A lot of people had a lot of savings when the economy was good and they were working. So they're sort of seeing them go down and down and down. A lot of people are collecting unemployment. A lot of people want to find a safe harbor for the money they have that will earn a little bit because it's not earning anything in the bank in a savings account, really. And at the same time, they want it to be pretty liquid, which means if not accessible tomorrow, accessible the next day when they're going to need it. So let me start out with your average middle-class, middle-aged family, someone in their 40s or 50s, children, elementary school, high school age, someone who is possibly got a new job, because a lot of people who worked in jobs for 20, 30 years are now working new jobs because of the change of the economy, and they're probably making $30,000 or $40,000 less than they were making when the economy was good in their other job, but they've had to settle for something that they could get because they might have been unemployed. Is there a way right now for them to still put money away, to save for their children's college, to not financially ruin themselves in doing so? And what do you suggest to people when they come to you and say, you know, I'm not ready to sign up for anything or to lock my money into anything. I'm not ready for an insurance plan. I'm not ready for a CD or something like that that's long term. What can I do with my money that will be liquid if I need it, or partially liquid if I need it along the way, because everything is so insecure today?
Okay, a very good question, Rabbi Doug. And the answer is, obviously, every person that we sit down with, every family or business owner, young, married, starting out, like you mentioned in the case of the 40 or 50-year-old middle age, and I used to think that 50 was old, but now maybe young even, the 50-year-old or the 70-year-old or 80-year-old that comes in, and we have clients of all ages that we work with, and everybody needs advice. I would say that every situation is different. Every person's situation is different. So somebody's coming here today at 4 o'clock and they want to have someone on the line with them. For their situation, I said everything has to be done separately, because what works for one person doesn't work for somebody else. First of all, so the case that you described, where somebody now took a pay cut and now they're working maybe even harder for less, and they still want to put money aside for their family, well, the first thing is I would talk to them about is what do they have in place right now? So possibly if they had worked in a company for 20 years, they may have had some retirement plan or some benefits built up from the old company.
But often those things aren't available until they hit 62 and a half. Is that correct? 62 and a half, the right age?
59 and a half.
59 and a half. See what I know? But that changed, right? It used to be 65 at one time, but now it's 59 and a half. So 59 and a half, and that's also when IRAs are available to people that they've put away, right? So let's say it's not available to them until 59 and a half, except possibly they have the opportunity in their former employer, whatever it was invested, of pulling it and putting it in another investment, reinvesting, so that they don't have to pay taxes on it because it's earning, right? Is that correct?
It's called a rollover.
Rollover.
Right, where they take the money, let's say that was in their previous employer's 401k, and they would, take it and invest it into their own IRA. They can actually bring it into their current employer's 401k plan as well, but they typically put it into their own IRA. Now, the fact that that money was earmarked for retirement, age 59 and a half, doesn't mean they can't get to it. There's just a little bit of a penalty.
Right.
But it is accessible. They can get to it if they need to. So it's nice to know that you've got some money. Somebody who's 50, they're 9.5 years away of being able to access that money.
Most people don't want to do that. Just like, for example, if someone takes out, I want to use the term whole life insurance policy, there are cash benefits that you can pull out of it to take out of your payout at the end if you need it in an emergency. People don't want to touch those things unless they're destitute.
Right.
So someone's coming to you and continue. I just want to mention that that's an important thing to know. Yes, there are things that people, when they were working hard, put away for the future, but they still want to save those for the future. They don't really want to touch those, and they want to still do something more because no one knows where things are going.
Right, but at least if a person may have $100,000 or $200,000 or $300,000,
that's a lot. But I wasn't even thinking that. I was thinking 30, 40, 50. But yeah, okay, go on.
Well, they may have if a person's put, they've been at an employer for 20 years and they put, $5,000, $10,000 aside every year, and depending on how they invested it, with decent growth or whatever, it can be worth. We've seen many cases. We've seen many instances where people have been at employers for 20 or 30 years, and they have, $200,000, $300,000, $400,000 from that previous employer.
So let me go back and give you a different scenario to look at.
Yeah.
I think of things, because I think of them in terms of lower middle class, I guess in my way, somebody who's a school teacher or working for a government office or whatever, they may have $30,000 or $40,000 only in a retirement plan from them, plus they might have put, because back in the day, the maximum you used to be able to put is $2,000 a year into an IRA. They might have put $2,000 a year into an IRA, and even though the maximum increased over the years, they felt they couldn't afford to put more. So if you're talking about 20 or 30 years, they're only going to have $60,000 and maybe another $30,000 in the employer's retirement fund. So we're talking about less than $100,000. In the other case, people are pretty set. If you have $300,000, $400,000 put away, and you're in your 50s, 60s, you're pretty set for yourself. Maybe not for your children so much, or grandchildren, but you're set for yourself. I'm thinking of the person who is, they've got enough money that when they retire, they'll be able to go 5 or 10 years.
Right.
Not the rest of their life.
Right.
Where are those people going today?
Right. Okay. First of all, what's very interesting that I found in doing this 16 or 17 years is that a lot of money to different people means different things. In other words, there are people that I've met that live on $25,000 a year, and they are better off financially than people living on $200,000 a year. Why? Because their expenses are much lower. So it's not really about how much you earn or how much you have. It's really about
how you manage your money.
Not only how you manage your money, but what your expenses are. So, at the end of the day, if you have somebody earning $500,000 a year, but their expenses are $600,000 a year, they're in a much worse financial position than somebody earning $30,000 a year, and their expenses are $15,000 a year. Okay, correct. So that's a fact, and it may seem crazy because every category you talk about, the guy who earns 100, if I would only earn 200,000, then I'd be on easy street. Or the guy who earns 30, if I could only earn 40. But it's really so. The reason why I say that is because you talk about the teacher or someone who may have only $100,000. And for that person, if they put aside $2,000 a year, and that was a big percentage of their income, they're living on a lifestyle that $100,000 will go a long way for them. Mm-hmm. So that's the first thing. So whether it's a teacher that comes in or whether it's anyone, it doesn't matter what their profession is. we sit down and we look at what their lifestyle habits are, what their situation is, how much money they have, okay, and how much they could put away. And no matter what a person earns, hopefully they should be able to put away something. That's the objective. We try to tell people, just like you put money aside, every month you're paying your electric bill, and every month you're paying your food bill, and every month you're paying your rent or your mortgage, pay yourself, because that's the money that you're going to have one day. Pay yourself. Take, whether it's $100 a month, $1,000 a month, $50,000 a month, whatever that number is, pay yourself.
So now you work in church, you also have an insurance broker's license, correct?
Mm-hmm.
You work with people taking out life insurance policies and so on, things such as whole life, and I just use that word because people know it, that also is an investment along with the life insurance. There are people who have other forms of investing their money on their own, such as playing the stock market. And certainly in the last 20 years, where the stock market is easily available without paying major commissions, people sit on their computer and buy and sell stock. Now, since probably the Clinton administration, it has dropped. It was real big then, and then all of a sudden when the market dropped, and as it keeps going and being so volatile, people are out of that. Do you get involved in suggesting people going back into the stock market at all?
Well, yes. In other words,
Okay.
I'm not a stockbroker.
Right.
I don't have a Series 7. But for people who like who don't mind the volatility, who like the good potential gains that they can get in the stock market, and we are involved in that with regard to like mutual funds and certain areas. So people can invest in
Sure.
a variable annuity or mutual fund. But that's for someone who likes the risk and doesn't mind seeing their statements go down. They can put money in, and the next day it can go down by 10%.
So as we go the end of 2011, the beginning of 2012, are these funds stable? Are they going up a little bit? Are they going down a little bit? 5 years ago, they went way down.
Mm-hmm.
They've sort of climbed a little bit in time. Where are they right now?
It's a very good question. It changes daily. Every day that you'd ask that question, the answer would be different. Especially the last few months, and the last month has been very up and down. But I don't
Mutual funds.
Mutual funds and the stock market in general. We had the Dow was over 12,000, and it went down below 10,000, and right now it's about 11,600 as we talk today. When we show it, maybe 12,000 or 15,000, or we may be at 10,000. I don't know what it'll be, but as we are today. So the question is, what does a person want to do? So in other words, what we do here in financial planning, and different financial planners do different things. Stockbrokers do different, but what we do here is we focus on primarily safe money. Where can a person take money, put it aside on a systematic basis, or put a lump sum into something that's completely safe and guaranteed? Okay.
Completely safe and guaranteed, and higher yield than a bank account.
Then higher than a bank account. Now, is there a vehicle out there that's available that I know of that you could put the money in, make 2, 3, 4, 5%, and it's accessible the next day, and it's fully liquid and guaranteed? It doesn't exist.
No,
it doesn't exist.
Not nowadays.
It doesn't exist today. But depending on the person's objective, if someone is older and they just need an income, they don't need to take their money all out at once. They just want to have something that can provide an income. So then there are fixed annuities for that. The rates change. You might be able to get something for 3 or 4 or 5%.
Usually lock it in. What is the safest term to lock things in at a little bit higher rate?
Well, you can get annuities that, let's say fixed annuities, that your money is locked in for a period of 5 or 7 or even 10 years, but you can take out a certain percentage.
You have a percentage you can take out without penalty.
Without penalty.
Oh, that's very good. See,
Yeah.
I didn't know that.
Yeah.
So certain annuities you're allowed to take out percentages without penalties.
Correct.
That's great.
Yeah.
And you could add to them also?
Yeah. Mm-hmm.
That is great.
Yeah, so that works usually very well for older people who are not looking to play a stock market. They just want to know they have a fixed income or whatever it is. You can even annuitize. A person can buy an annuity, and annuitize that annuity means they get a guaranteed fixed stream of income for their life. So no matter how long they live 20 more years, or 40 more years, or whatever, they get that income for life.
So sort of the amount that you can take out without penalty becomes a monthly check or something like that in coming to them as income.
Right.
That is so cool. See, I had no idea about this. I don't know much about annuities at all.
Yeah.
So it's something new for people who aren't familiar with annuities. What about IRAs today? Now, what is the maximum one person can put in? I know, like I said, when I was first starting my career out of college, it was $2,000 a year, went up to $4,000.
$5,000.
It's $5,000 now.
Per
person. And so a couple can put in, a married couple can put in $10,000 a year and save it for retirement. 59.5 they can start withdrawing.
Right.
Without penalty.
Right. Now, but the question is, is that appropriate for everyone? Because, depending on their tax bracket, for example, if someone is in a very high tax bracket today, and in the future they're thinking they'll be in a lower tax bracket because they'll be retired and they'll have less income, so then that type of qualified putting money aside on a pre-tax basis is good because they'll get a tax deduction today, so it'll lower their income taxes, and then in the future, when they take the money out, they'll be in a lower tax bracket, so they'll be, that's a nice thought.
Now let's bring up an important point that people need to know, which I do know and I want to bring up, is that if you haven't been investing in an IRA and you're interested in investing in an IRA, it's important to know that you can only write off if you're not receiving another retirement plan. If you are in a retirement plan, you are not allowed to write off, and it's better to go with a Roth IRA. Is that correct?
Well, let's put it like this. First of all, I just have to give this.
I want your expert opinion. That's why I'm asking.
Let me give a disclaimer that I'm not an accountant, and any tax advice really has to be run by someone who's an accountant, a CPA. But that thought that you said is a correct thought. But some people don't qualify for a Roth IRA. If you earn over a certain amount of money, let's say a person earns $180,000 a year. They don't qualify for a Roth IRA. There are other vehicles that they can do. They can put money in. But so yes, that type of, together with an accountant, that type of planning comes into account. As far as Roth IRA, traditional IRA, if you coordinating that with your, let's say, 401k or 403b or 501c plan that you have.
Whatever they are.
Whatever you work. You work for a hospital, you work for a nonprofit, you work for corporate America. So those all have to be coordinated. Both from a tax standpoint and from just a what makes sense standpoint. Okay? And then, but to go back to your question about insurance, so people do use life insurance as a way to put money aside. They do that. Why? Because there's a cash value that builds up on a guaranteed basis. So it's,
and usually not always, but usually it's at a higher interest rate. The guaranteed interest rate or lowest. That even if it's flexible, there's usually a bottom that most insurance companies have on there that will guarantee you a higher rate than certainly most bank accounts.
Right, I mean, you have to look at it depending on the rates, but yes.
Could you tell our viewers, because a lot of people don't have insurance, unfortunately. I do know what it is, but tell people the difference. What is term insurance? The title term insurance, explain to them.
Okay, well, first of all, the whole premise of getting life insurance is if something were to happen to you, God forbid, you want to be able to provide the same income or an income for your family, and if something happens in terms of death or disability. Disability insurance covers for the, God forbid, a person becomes disabled. And unfortunately, we've dealt with a number of people that have had both, both disabled and passed away. So you want to make sure that your family is taken care of, because if not, then the family will be kicked out of the house or whatever.
God forbid lose their financial assets that they have.
Right, I mean, if God forbid something happens, it's hard enough that a person passed away, but on top of that, not to have any money anymore is devastating. So that's why you have life insurance. Now, the question is, how much life insurance does one have? Well, that is a function of how much they're earning and what income they need to replace. So if something happens to them and a person who's earning, let's say, $50,000 a year, so then they probably want to have enough insurance, or at least enough assets that could provide an income stream of $50,000 a year or more, because
plus pay off their mortgage and their cars or something like that at the same time, so that the spouse and the children are able to survive.
Right, but not only that, but the thing is that what people don't think about, and this is something that I teach this to people all the time, is they think about their financial situation today. They think about if something happens today and they were earning $100,000 a year, if they provided $100,000 a year for their family for the years to come, their family will be okay. But the fact is that that's not the case. Because with the cost of living going up. For example, I remember growing up, there was a show on TV, LA Law. I don't know if you remember that?
I'm familiar with it. I wasn't a fan. But
wasn't a fan. Well, I was a fan. And what happened on that show, one episode of the show, was there was a new attorney that was hired. And the LA Law epitomized the top income, in the whole country. Lawyers making big money. Anyway, so one lawyer got jealous of the other lawyer because he found out how much he was hired for. And what was that big number? This is like maybe 1987. But that number was, $75,000. Now, I'm not saying that that's a bad salary. Someone was $75,000, but I'm saying, but certainly
Changed now.
It changed. Now that lawyer may be earning $300,000 or $400,000. Now, let's assume for a second that somebody had insurance to cover their family at that $75,000 level. Well, fast forward 10, 15, 20 years later, that family would not be able to survive.
At least at the same lifestyle that they were living at.
Right. They'd have to significantly. So a person should not only provide for now, but it's also for the future, for many years to come. Now there are different things. People can say that they're, that they can get a job, or their kids will grow up, and all that it's got to be taken into account. But a person needs a lot of insurance if something happens.
Absolutely. Let's go into another subject that you and I both personally live with, and that is children who are going to parochial schools or Jewish day schools, and they're paying tuitions. Mm-hmm. We're not talking about saving for college. Yeah. We're talking about that college tuition is every year for our families and our children because they're going to private school. What can a person do while their children are in school and they're already paying tuitions to save for the future? When college comes along, if tuition this year, let's say high school tuition per student in the schools that we send our children to, let's say high school tuition is $20,000 to $25,000 a year per child, which may be low in the big picture with everything added on to it. But let's say that is, and college tuition is going to be about $10,000 more than that, or maybe $30,000 or $40,000 more than that, depending on what school and what profession your children are going to go into. What can we do to save while we're still paying?
Right. Well, in our community, it's a unique issue in that it's very, unless a person is earning $500,000, $1 million, $2 million a year. I see people that they're paying $100,000 a year in tuition.
Yeah.
So if they're paying $100,000 in tuition with after-tax dollars
between their two schools, the elementary and the high school and everything.
Yeah. I mean, I've got 6 kids in school.
Yeah.
I'm paying tuition for 6 kids.
Yeah.
So it's difficult for someone to put money aside for college. So my thought process with that is that if you can put a little bit aside, if you have a few dollars, put it aside. But ultimately, the kids are going to probably just have to take student loans.
Uh-huh.
I mean,
student loans are the way to go. You think?
Well, they may have to. I mean, the only other thing is that if a person's used to paying that kind of money, $20,000 a year per kid, while they're in high school, and now they're going to transition into college, and the family can still continue to pay at least that $20,000, that might cover half of the tuition or whatever.
I remember when I was a senior in college, my bank account was earning 13%. My savings accounts in the bank were earning 13%. I was able to take out, just for 1 year I did it, Illinois guaranteed loan at 7%. I was earning 13, I took it out at 7. I had enough money in the bank to pay it, but this seemed like a better issue. I put the money in the bank and was paying off school slowly. I was earning higher than I was paying on it, and I had suspended after I finished school until I finished graduate school to have to pay it off. And I did pay it off. I'm not one of those people who didn't pay off their own loans.
It's called arbitrage.
It was great.
That's exactly arbitraging, yeah.
Let me go to another issue, and that is seniors.
Okay.
Seniors have this money, and they have to make a decision. I'm not going to live forever, but I want to prepare for myself. I want to be happy the rest of my life through my retirement, which might be coming up or might be here already. But I also want to take care of my children. I want to take care of my grandchildren. Do I skip the children and start setting up financial savings or plans or accounts for my grandchildren, invest things for them, or do I do it for my children and let them do it for my grandchildren? Do I worry about my funeral in advance? Do I take care of my own, buying my own plots in the cemetery and prepaid funeral plans so I don't worry about that later? Or do I put that money aside and give it to my children so they can take care of it? What do you suggest as the professional?
Well, again, the great points. I mean, it really depends on the person's personal preference. So, an older person that comes in and says that they don't trust their kids, but they want the money to go. There are certain documents and trusts that people can implement with an attorney that can dictate where the money goes and when and how and where. Exactly when, how, and where the money goes. So it's a personal. Someone may have a child or grandchild with special needs, right? So they may say, I want to have, X amount of dollars going to that situation, and then the family who has the child with special needs would set up a special needs trust and so on. So it really just depends on the person's personal preference. As far as buying, prepaid funerals, I mean, people do that as well. People typically don't like to be a burden on their family. Some people say, I don't care, when I'm dead, I'm dead. I mean, just everyone's different in that way.
What, are more people saving for their grandchildren or leaving it for their children to do? That was the question you didn't answer. I was asking.
I don't know the answer. I don't know the answer to that. I mean, different people do it differently. I know we have many people who've set up accounts for their grandchildren. A number, probably 100.
Or they might go to a lawyer and set up a will and set up something that will distribute to them.
Right. Well, first of all, as far as I'm glad you mentioned the will. It's important that everybody have a will, especially if you have kids.
A living will and a will for after you're gone.
Right. Well, first of all, healthcare durable power of attorney. And again, I'm not a lawyer, so I don't want to say, but if something happens as far as who makes decisions, medically and so on and so forth. But also, if I don't have a lot of money. Why do I need a will? Well, if the person has kids, especially if the little kids, what happens to those kids if something happens to them? I mean, so one will say, well, of course it'll go to my mother, or the kids will go to my brother. Well, not without, if it's not in writing, you don't. If you have it in writing, you've decided it. If you don't have it in writing, some judge is going to decide it. Now, hopefully, the judge will be straight and fair and right and say, yeah, so here's the best. But and it could be that the brother may not want to take the kids. Maybe the brother's got their own issues. And these type of things have to be reviewed because I can tell you personally, when we had one situation, and then as families grow and things go on, and other families grow, it's it's not easy anymore.
How do you, and just in closing, because we only have a couple of minutes left.
This one's so fast.
It does go fast. There are so many subjects we didn't get to cover. I hope you'll come out again and we
of
can talk
course.
more. You
have to come out here.
You have a number of awards that you've received over the years for the things you do. You're involved in board of directors of different charitable organizations and so on and so forth. How do you find the time to devote to your family? You have a special needs child. How do you find the time to devote to your family, be on the board of directors of different organizations, and do your job properly for your clients and so on? How do you shuffle your time? You're a busy person.
Yeah, that's a great question. I don't know the answer to that question. I mean, you just got to do the best you can. I mean, I get up every morning at 4:30. I work out. I go learn and daven, and then I try as best as I can to be home, for the family at night. And
so you go to sleep at 2 o'clock and wake up at 4:30 every day.
No. And you try. You really try. I mean, you work and you try your best.
Very nice, very nice. Any closing words for our audience on if they're going to their financial planner, what should their number one question be?
Well, my closing thought, I don't know about what the number one question should be, but I can tell you what your number one objective should be, and that is to do something. And what I mean by that is, and I'll ask you this question, Rabbi Doug, there are 3 frogs sitting on a lily pad, and one of them decides to jump off. How many are left?
2.
2, right? The answer is 3. Why? Because one decided to jump off, but they didn't actually jump off. So our job, and the jobs of financial planners with regard to finances, is to get the people to move forward, to do the things that they know they have to do.
For their own benefit.
For their own benefit. To put money aside, to have a retirement plan set up, to have money aside for their future, for their kids if you can, to have life insurance, to have disability insurance. And most people I should do it, I will do it, one day I'll do it, maybe I'll get a will. Our job is to push the person off the lily pad and start something.
And someone who doesn't have descendants and doesn't know what to do with their money, a financial planner can help them suggest what to do as far as charitable ideas too, right?
Yeah.
Absolutely great. I want to thank you so much for being on the show. Howard Suss, financial planner. I want to thank all of you for being with us. Remember, you can check out our website, www.tvrabbi.com, where you can also watch previous shows on the web. And also, if you want to email me, or if you want to email something that you want me to pass on to Howard, I know he'll get back to you, info@tvrabbi.com. I'm sure he'll be happy to answer any of your questions. I want to thank you for being with us. Remember, we're on every week at this time. Hope to see you next time right here on Taped with Rabbi Doug. Shalom, everyone.
We're going to see Rabbi Doug on your TV tonight.
This has been a Taped with Rabbi Doug production.